From the News Channel 5 Network, this is OpenLine.
Monday night, everybody, time for Open Line. I'm Rhori Johnston. Thanks for tuning in here on News Channel 5 Plus. And tonight we have another important financial topic to bring you. We really hope you'll take advantage. Give us a call at 737-PLUS with your comments or questions. A great opportunity for you to get a little bit of advice and hear a little bit from our expert, and that is Mr. John Navin. From John Navin and Associates. Good to have you back, sir.
Thank you.
Thanks
Pleasure
for being
to be here.
Third time now, right?
Third time.
All right.
I'm
Get to be a regular. Yeah, we like it. So much to talk about during times as we head into the fall. Kids going back to school. I know one of the things, my daughter is now in high school, and it's really made me think, oh my gosh, am I that close to college? You know, it starts to, recalibrate. You start to recalibrate things about, okay, where am I with my investments and whatnot? And really, one of the interesting things we want to talk about, folks, with John tonight is the risk involved. And of course, there is a risk with any type of investment, but also how that compares with, your return on your portfolio. We're going to talk about some of the different options that are out there. And what I've found interesting in some of the material you sent over, the costs and the hidden fees.
Oh, yeah.
There really are a lot, and most people, why aren't they paying attention to this stuff? And the long term, it can really add up.
Oh, tremendously. I would say the real reason is that there's so much information that comes.
Yeah.
We're inundated with everything from regular life stuff, let alone now we've got to pay attention to these mutual funds and these fees and these costs and prospectus. Are you familiar with the prospectus?
Yeah.
Okay.
Yeah.
And how many times have you read one?
Zero.
Very much similar to most people I talk to.
Those real thin paper books that are just filled with information, that come in the mail quarterly or whenever, right?
And most people take those and they go just like this and they put
into
them
the recycle bin.
Into the recycle bin, because there's so much information you just can't read them. But in there is where you're going to find all the buried fees about how much people actually pay and the true cost of ownership. Not all mutual funds are bad, but it's really something, if you're going to take on a risk and you're going to make an investment, really understand what your total costs are, because that will have a tremendous impact on your portfolio.
I've heard that there are all sorts of funds out there, front load, back end, or whatever. I don't know how where you're going to pay up front. And obviously any investor, most investors know there's going to be a cost associated.
Sure.
You have a group of people who are managing certain portfolios and they have to be paid, and there are fees for that, but they get paid a portion of the return, or how, based on the performance of the fund, right? That's how it works, or?
They can. Most are a flat fee. So, for example, we are fee-based only advisors. So we have a different responsibility than most. There's different types of advisors. There's a fiduciary advisor, which we are, and there's a suitable advisor, which are most of your brokers. And basically, neither one are good or bad. It's just which one you look at. For example, a suitable advisor, all they have to do is make sure the investment is suitable for you, and they can sell it to you. So a lot of times what will happen is, it's the old adage of all you have is a nail or a hammer, everything becomes a nail. So you're still selling the same fund, the same investment. Whereas fiduciary or investment advisors, we have a moral, legal, and ethical obligation to do the whole planning side. And so we just charge a flat fee depending upon the assets. So whether it performs good or bad, unfortunately, we want it to perform well because the advisor makes more money. But if it loses, well, then we lose because there's less money in there. So, and that's just one fee. You mentioned too the front end load and the back end load and the C share, the A share, B share, F share. They're all different shares depending on how you buy them.
Right.
So all the fees.
And it's your job to have to keep up with all that. Fortunately, not ours. That's what we're paying you to help us do. So, the day to day, we toss that prospectus. And as a matter of fact, I think I've even gotten to the point where I've told these companies, save the paper. Yeah. You can email me or whatever, but just don't even bother. I don't have time for it, which is pretty typical.
Yeah, by most. And those are the fees you see. The fees you don't see are the transaction costs, or they call it the cash drag, or they call it the turnover expenses, because the mutual fund manager is turning these stocks. They're buying and selling stocks or bonds or whatever you ask them to buy. they're turning that portfolio over. So there's a cost that they don't have to disclose. They only disclose the ABC share and the brokerage commission. You have to disclose those, but you don't have to disclose the rest of them. So those can be upwards of another 1.5%. And not all funds are created equal. You know, some managers charge more money and some are less. It just depends on, again, the fund and how they're performing.
How do you go about choosing the funds for your clients, and where you think, you know, the right, you know, what the right choice is? And obviously you're looking at all these fees and what they're charging, right?
Sure. One of the biggest things we look at is the expenses. So we want to make sure if we can keep the expenses lower, it's going to increase the performance of the portfolio. That being said, the first thing we do is something called a portfolio stress test. So when clients come in, typically, they're nervous. They don't know what to expect, what's going to happen. So we try and break that ice. And we've talked about that before, making it an easy transition to come in and feel comfortable. But we run this portfolio stress test, which basically is taking all of their investments. We use Morningstar. So we run everything through Morningstar, which is a unbiased reporting software program that people will then, we can put their funds in and we can see how they compare to the rest of the funds out there. So this portfolio stress test will not only tell us how their funds are performing, how much risk they're taking, it'll also tell us what kind of fees they're paying from the turnover side, and from that point, we can then go, all right, let's look, and we use a bucket system because it's simple. We have a cash bucket, we have an income bucket, a short-term bucket, and a long-term bucket. And you put different vehicles, mutual funds, investments, some people use investment money managers. Just depends on what they want to use. And that's where we do the research and plug in what's best for what they're trying to achieve.
Typically, younger clients are probably going to fill the long-term bucket a little more, and it just, you know, really depends on. So an old guy like me, I need to be looking at cash and short-term now.
Yeah, I mean, at first you're not old, but after we get past that little hurdle, you want to have enough in cash. Just everybody needs some money at the bank, but you don't want to have too much money at the bank because you're not going to get you're going to get 0.5% or a quarter of a point. The next bucket is we're going to look at your income. So if you said, John, I want to make sure I retire with X number of dollars, well, then we've got to carve out a piece of your portfolio that guarantees or has a very, very good chance of generating the income you need during retirement. Then we can do a short-term bucket, which is 3 to 5 years, and a long-term bucket, which is 5 years plus. We want to compare those investments to the different options that are available in each one of the buckets. So cash money, what are the best places we can get with cash and zero risk or low risk? Short-term, income, and long-term, same thing. We just want to make sure we do the research and find out where it goes.
And typically with that, are you moving from the bonds, which are the lower risk, up to stocks, or just those? Is that just a myth?
It's kind of a myth.
It is.
Bonds are an asset class.
Yeah.
Just like stocks, just like REITs, just like gold, just like oil. They're all just an asset class. And bonds right now are typically extremely low if you look at it because interest rates are low.
Yeah.
So, yeah, bonds are predominantly just an asset class, still carry risk. So you want to make sure you know what the risk is that you're going to be involved in when you make that decision to invest.
And I want to put something up on the screen before we take our first break. An offer that you are putting out, is that right?
Yes.
All right,
please.
let's take a look at this. We'll see what's up there. Do we have that, Courtney? There it is. So typically this costs a little bit of money. I mean, you charge some money for this, but if people call in, you're going to give out some free ones.
We'll do it for free.
Oh, that's great.
So if they call or they come off the show, we'll offer the portfolio stress test for free, which is really, again, a non-threatening way for us just to begin to evaluate the portfolio.
How long does it take?
The meeting, we would have a meeting of about 30 minutes. We'd put the information in. They'd come back for a second meeting, basically just lay out all of their information as to where they are. Because that's the problem. There's not good information. We're still inundated and bombarded, and most people that you go see are trying to sell you something.
Right.
So, no, we don't sell anything. If it makes sense to do something after you see where you are, then you move forward. If it doesn't, stay where you are.
Sure. Interesting. All right, 615-737-PLUS is the phone number, everybody. 615-737-PLUS if you would like to call in with a comment or a question. We're going to continue our conversation with John after this quick break. Stay with us.